Welcome. What I'm about to share with you today is a financial strategy that has been quietly used by some of the wealthiest families and institutions in America for over a century. It's called the infinite banking concept, and once you understand how it works, you'll never look at your money the same way again. Most of us have been taught to save money in a bank, invest in a 401k, and take out loans when we need capital. But there's a completely different approach, one where you become the bank, where you control your own capital, recycle it endlessly, and never have to ask permission to access your own money. That's what this presentation is about. We're going to cover how it works, who uses it, how real estate investors are using it to accelerate their portfolios, and what the numbers actually look like. So let's dive in. Quick disclaimer. This is for educational purposes only and does not constitute financial, tax, or legal advice. Results vary and are not guaranteed. Certain strategies may involve insurance products. Product availability and features vary by carrier and state. Please consult your professional advisors regarding your specific situation. At its core, the infinite banking concept, or IBC, is a wealth strategy built around a very specific type of life insurance, dividend-paying whole life insurance from a mutual-owned company. It was developed by economist R. Nelson Nash and introduced in his book, Becoming Your Own Banker, back in 1990. But the wealthy had been using this same strategy for generations before Nash ever wrote about it. Here's the core idea. Instead of storing your money in a bank, where they earn the interest and control the terms, you store it inside a whole life policy that you control. When you need capital, you borrow against your policy's cash value, not from a bank. And here's the key. While your money is out working for you, your full cash value continues earning the average 5 to 6.5% total return inside the policy, simultaneously. Think about what that means. You borrow at 4.5%, and your money keeps growing at 5 to 6.5%. That's an arbitrage spread working in your favor. The same concept banks use every single day. The difference is now you're the bank. Before we go further, I need to be very clear about one thing. Not all life insurance is created equal. The infinite banking concept uses a very specific type of policy, and most financial advisors either don't know about it or won't tell you about it. We're talking about dividend-paying whole life insurance from a mutual-owned insurance company. Not term life, not universal life, not variable life, whole life from a mutual company. Why mutual owned? Because in a mutual company, you are the policy owner and a partial owner of the company. When the company profits, those profits are returned to you as dividends. That's where the additional return comes from beyond the guaranteed base rate. The policy has several key features. First, guaranteed cash value growth, minimum 2 to 4% annually every year, regardless of market conditions. Second, a guaranteed death benefit. Your beneficiaries are protected no matter what. Third, a non-correlated asset. Your cash value doesn't drop when the stock market crashes. Fourth, a PUA rider. That stands for paid up additions, which is the critical component that accelerates early cash value growth and makes this strategy work. Without a properly structured PUA rider, you don't have an IBC policy. You just have a regular whole life policy. The structure matters enormously. Now let's talk about how this actually works in practice. There are 3 steps in the IBC banking cycle, and once you understand these 3 steps, everything else falls into place. Step 1, you fund your policy. You pay premiums into your whole life policy, which builds your cash value. This is your personal bank vault. Instead of depositing money into a checking account earning 0.01%, you're depositing into an account earning 2 to 4% guaranteed, with an additional non-guaranteed dividend on top. Step 2, you borrow against your policy. When you need capital for a real estate deal, a business purchase, a car, anything, you take a policy loan from the insurance company. You're not withdrawing your cash value. The insurance company loans you their money, using your cash value as collateral. Your cash value keeps growing the entire time. Step 3, you repay the loan, ideally with the profits from whatever you use the money for. When you repay, your full borrowing capacity is restored, and you're ready to do it again. That's why it's called the infinite banking cycle. There's no limit to how many times you can cycle through this. And unlike a bank loan, there's no approval process, no credit check, no fixed repayment schedule. You repay on your terms. Let me show you the math because this is where it really gets compelling. The traditional banking system works like this. You deposit money at 0.5%. Your bank turns around and lends it out at 7 to 8%. The bank keeps the spread. You're financing the bank's profits. IBC flips this around. You're the one earning the spread. Here's a simple example. Let's say you have $100,000 in cash value in your policy, earning 5.5% average per year. That's roughly $5,500 in growth. You take a $100,000 policy loan at 4.5% to invest in a real estate deal. That's $4,500 in loan interest per year. Your policy is still growing $5,500 annually on the full $100,000 because the insurance company doesn't touch your cash value when they loan you money. So on net, you're effectively borrowing for free or even earning a positive spread while your capital is deployed in a real estate deal generating additional return. Now compare that to a hard money lender at 12% or a bank at 7 to 8%. The cost of capital advantage is dramatic. This example shows how policy cash value can continue working even while you access it. In this scenario, you have $100,000 in policy cash value and you borrow $80,000 against it to use for a real estate deal or another investment opportunity. Even though you borrowed against the policy, the full $100,000 is still inside the policy and continues earning. Using an average return of 5.5%, that creates about $5,500 of policy growth. On the other side, the loan on the $80,000 comes with a 4.5% interest cost, which is about $3,600 per year. So when you compare the policy growth to the loan cost, you still come out ahead by roughly $1,900 per year from that spread alone. Then, if that $80,000 you deployed into real estate or another investment earns 8% cash on cash, that adds another $6,400 of return. Combined, that creates a total annual benefit of about $8,300, which is an 8.3% return on the original $100,000. The big idea here is that your money is still compounding inside the policy while also giving you access to capital you can put to work elsewhere. Now, who is actually using this strategy? The answer might surprise you. Real estate investors love IBC because it gives them a reliable, low-cost line of capital to fund down payments, bridge deals, and avoid the 10 to 14% rates charged by hard money lenders. Every time they close a deal and repay the loan, they're ready for the next one. Business owners use it for equipment purchases, working capital, payroll financing, and business acquisitions. It essentially replaces their relationship with the bank for day-to-day capital needs. Every day, families use it for college funding, estate planning, and creating tax-free retirement income. The death benefit also makes it an incredible generational wealth transfer tool. Financial professionals and sophisticated investors use it as an alternative to bank CDs, a complement to their 401k and IRA, and a volatility buffer during market downturns, because the cash value never goes down. In short, anyone who needs to access capital regularly, or anyone who wants to build real, controlled wealth outside of Wall Street, is a candidate for IBC. Here's something most people don't realize. The IBC strategy isn't new. The ultra-wealthy have been using whole life insurance as a banking tool for well over 100 years. Take the Rockefeller family. They've been using whole life policies to store, protect, and transfer wealth across 5 generations, going back to the 1870s. The family's wealth is still compounding today, in large part because of this strategy. That's not coincidence. That's an intentional, multi-generational wealth system. Walt Disney borrowed against his life insurance policy to fund the construction of Disneyland in the 1950s. Banks had already turned him down. He used his whole life cash value as collateral and went on to build one of the most iconic entertainment empires in history. JCPenney used his whole life cash value to save his retail business during the Great Depression of the 1930s. When traditional credit markets froze, his policy cash value was the only liquid asset he could access quickly. These aren't obscure stories. These are legendary American entrepreneurs who understood something that most people today still don't. Controlling your own capital is the ultimate competitive advantage. This next slide might be the most powerful one in this entire presentation. And I want you to really sit with this for a moment. The largest banks in America, Bank of America, Wells Fargo, JP Morgan Chase, they collectively hold over $182 billion in bank-owned life insurance, BOLI. It's the exact same whole life insurance strategy we've been talking about. They use it to earn tax-free returns on their excess capital. They use it as a stable, guaranteed return asset on their balance sheets. They use it to fund executive benefits and key person life insurance. And these are the same institutions telling you to put your money in a savings account at 0.5% or a 401k where you have no control. The Kennedy family is another example. Joseph Kennedy Sr. used whole life insurance as the cornerstone of his wealth transfer strategy, sheltering assets from estate taxes and creating the framework for a multi-generational financial dynasty. If the largest banks in the world trust this strategy with hundreds of billions of dollars, why wouldn't you consider using it for your own financial future? The question isn't, is this a good strategy? The question is, why didn't anyone tell me about this sooner? Real estate investors in the infinite banking concept are a natural fit. Let me show you why. The number one problem most real estate investors face is capital velocity. How quickly can they access money to close deals? Traditional financing has timelines, credit checks, appraisals, and approval processes. Even a HELOC can take 45 to 90 days to tap. Policy loans available in 3 to 5 business days. No approval, no questions asked. Think about the real estate cycle. You see a deal, you need to move fast, you deploy capital, you close, you refinance or sell, you repay your policy loan, and you're ready for the next deal. The IBC policy acts as your private line of credit that you control completely. Here are 4 specific ways real estate investors use IBC. First, as down payment capital for buy and hold rentals. Second, as bridge financing for fix and flip projects while conventional financing is arranged. Third, to avoid hard money lenders charging 10 to 14% plus points. And fourth, to fund renovations and capital improvements without tying up external credit lines. The cost advantage is significant. At 4.5% policy loan rate versus 10 to 14% hard money on a $100,000 bridge loan, that's $5,500 to $9,500 in annual savings per deal. Across multiple deals per year, that compounds quickly. Let me walk you through a real example of how infinite banking can work alongside real estate. In this case, the investor built this position by funding their policy with $50,000 per year over 5 years, and at this point has approximately $220,000 of cash value available. Instead of pulling that money out or interrupting its growth, they borrow $175,000 at 4.5% and use that as the down payment on a $550,000 rental property. On the real estate side, after the down payment, there's a $375,000 mortgage at about 7%. The property rents for $3,800 per month, and after mortgage, taxes, insurance, and management, it produces about $580 per month in positive cash flow, or roughly $6,960 per year. At the same time, that $220,000 remains inside the policy, continuing to grow at around 5.5% on average, generating roughly $12,000 annually, and even after accounting for the $7,875 loan interest, there's still a net policy gain of about $4,200 per year. When you combine everything, the rental income, the policy arbitrage, plus an estimated $16,500 per year in appreciation, and about $5,400 in mortgage paydown, the total annual wealth created comes out to just over $33,000 per year, which is roughly a 15% return on the original capital contributed. The key takeaway here is that the same dollars are doing 2 jobs at once, continuing to compound inside the policy while also being deployed into real estate, which is where the real power of this strategy comes from. Let's do a direct head-to-head comparison so you can see exactly what you're getting and what you're giving up with each approach. We will start with a hard money loan, 10 to 14% plus 1 to 3 points, funds in 5 to 15 days, but with heavy fees, short terms, and high pressure to exit quickly. Next, let's look at a conventional bank loan, 7 to 9% and climbing, 30 to 90-day approval process, credit score dependent, rigid repayment terms, early repayment penalties on some products, and zero growth on your capital while it's deployed. Now let's look at an IBC policy loan. 4.5% interest rate, funds available in 3 to 5 business days, no credit check, no approval process, no penalties for repayment on your own schedule, cash value keeps growing the entire time, and tax-advantaged growth. The IBC policy wins on rate, speed, and control. Where it requires patience is in the build-up phase. It takes 1 to 5 years for the policy to build cash value. But once it's established, it's the most flexible capital tool available to individual investors. This slide shows the long-term power of building your infinite bank over time. In this example, it's funded with $2,000 per month or $24,000 per year, with an average return of around 5.5%, though this is just an illustration. What matters is how it grows. By year 3, you have about $65,000 in cash value, with $55,000 available to use. By year 5, around $118,000. By year 10, roughly $280,000, enough to start funding multiple deals. And by year 20, about $670,000 in cash value with over half a million accessible. And this is just based on the monthly funding. You can accelerate growth by adding a lump sum each year on top of the $2,000, which builds cash value even faster. The big idea is consistency. Over time, this becomes a powerful pool of capital you can use and reuse while it continues compounding in the background. Let me summarize the key benefits because there's a lot here and I want to make sure it's all clear. Benefit 1. Liquidity and control. Access your money anytime without bank approval, credit checks, or waiting periods. You're in charge. Benefit 2. Guaranteed growth. Your cash value grows at a minimum of 2 to 4% annually, every year, regardless of what the stock market does. Add in non-guaranteed dividends from mutual companies, and the average total return has historically been 5 to 6.5%. Benefit 3. Tax advantages. Growth is tax deferred. Policy loans are tax-free. Death benefit is income tax-free. No contribution limits like an IRA. Benefit 4. Simultaneous compounding. Unlike a 401k where your money is locked away, an IBC policy lets your capital work in two places at once, in the policy and wherever you deploy the loan. Benefit 5. Protection and legacy. Your family is protected by the death benefit throughout, and the policy structure is designed to transfer wealth efficiently to the next generation, which is exactly why the Rockefellers, Kennedys, and other dynastic families have used it for decades. Let me address the 4 biggest misconceptions I hear about IBC, because there's a lot of misinformation out there. Misconception 1. Whole life insurance is a bad investment. This one has been repeated so often that people believe it without questioning it. But it's based on comparing whole life to aggressive stock market investing and ignoring the banking function entirely. IBC isn't about investing, it's about banking. If you compare it to where you keep your banking capital, savings accounts, money market accounts, CDs, it wins every time. Misconception 2, the returns are too low. Again, this misses the point. The 5 to 6.5% average return is on your banking capital, money that would otherwise be sitting in a checking account earning 0.5%. Plus, you're deploying that same capital into investments. You're not choosing between the policy and the investment. You're doing both simultaneously. Misconception 3. The fees are too high in the early years. Yes, first-year costs are front-loaded. This is real. The solution is to think of this as a 10 to 20-year strategy, not a short-term play. Anyone who tells you IBC is a 2 to 3-year strategy is misleading you. Misconception 4. I can just do this with a savings account. You can't replicate the guaranteed growth, tax advantages, creditor protection, death benefit, and non-correlated asset characteristics of a properly structured whole life policy with any other product. There's simply no direct substitute. So how do you actually get started? Step 1, and this is critical, find the right advisor. Not all insurance agents know how to properly design an IBC policy. Most don't. You need to work with a licensed insurance professional who specializes in structuring dividend-paying whole life policies for maximum early cash value growth. The difference between a well-structured policy and a poorly structured one can be tens of thousands of dollars in accessible cash value in the early years. Step 2, understand your cash flow. You need to know how much you can consistently commit to annual premiums. IBC works best with consistent funding. Typical starting points range from $500 to $2,000 per month. Step 3, choose the right mutual insurance company. Not all mutual companies are equal. You want companies with strong dividend histories, 100 plus years of consistent dividends, excellent financial ratings, and a commitment to the traditional whole life product. Not all mutual companies are equal. You want companies with strong dividend histories, 100 plus years of consistent dividends, excellent financial ratings, and a commitment to the traditional whole life product. Step 4, structure the policy for maximum early cash value. This means loading the policy with a PUA rider, paid up additions, so that a large percentage of your premium immediately converts to cash value instead of covering pure insurance cost. This is what separates an IBC policy from a standard whole life policy. Step 5, fund it consistently, start borrowing strategically, and build your banking habit. The earlier you start, the longer the compounding runway. Okay, so we've covered a lot today. Let me leave you with the most important idea of all. Infinite banking is not a product you buy. It's a process you adopt, a completely different philosophy about how you use, store, and deploy your capital. For too long, most of us have outsourced our banking to institutions that profit from our ignorance. We store money in banks that earn 10 times what they pay us. We borrow from lenders who charge 7, 10, 14%. We lock money away in retirement accounts we can't touch for decades. The IBC system asks, what if you were the bank? What if every dollar you needed for a car, a business, a real estate deal first flowed through your policy, generated returns for you, and came back to you with interest? The wealthy have been doing this for generations, along with the largest banks in America. The question isn't whether this strategy works. A century of evidence shows it does. The question is, are you ready to think differently about your money? If you are, reach out. Let's talk about what a policy designed for your specific situation could look like. Because financial freedom isn't about what you earn, it's about what you control. Thank you for your time today.